Financial illiteracy is a silent threat that shadows individuals from adolescence through old age, shaping destinies in ways both visible and hidden. Its dangers are not confined to any one moment, but instead accumulate, compounding quietly until they burst into crises that can derail hopes, families, and futures. Understanding exactly how financial illiteracy undermines well-being at every stage of life is the first step toward breaking this cycle and building a foundation for lasting security. In youth and early adulthood, the seeds of financial trouble are often sown through a lack of basic education about money. Young people, eager to pursue higher education or newfound independence, are bombarded with offers for student loans and credit cards. Without a clear grasp of how interest, repayment schedules, and credit scores work, they may sign up for debt obligations that far exceed their ability to repay. Imagine a college student who, dazzled by the freedom of a credit card, accumulates $5,000 in debt at a punishing 20% interest rate. If they make only the minimum payments each month, that debt lingers for years, growing ever larger and siphoning away money that could have been saved or invested. The benefits of compound interest, one of the most powerful tools for building wealth, remain a mystery. Savings accounts are neglected, and the habit of spending now, worrying later becomes ingrained, setting the stage for future hardship. As young adults transition into the career-building phase, the stakes grow higher. A steady paycheck may arrive, but without the skills to budget, save, or invest wisely, even a good salary can slip through one's fingers. Many find themselves living paycheck to paycheck, unable to withstand even a minor financial shock. The absence of an emergency fund is especially perilous. Consider the employee earning $60,000 a year who suddenly loses their job. Without savings to fall back on, they may be forced to take out high-interest payday loans, rack up credit card debt, or even file for bankruptcy. The stress of financial instability can spill over into work performance, relationships, and health, creating a vicious cycle that is difficult to escape. Midlife and family years bring new responsibilities and new risks. Major life purchases, like a home or a car, often involve complex financial products. Without understanding loan terms, interest rates, or the implications of adjustable-rate mortgages, families can find themselves blindsided by rising payments they cannot afford. For instance, a family might buy a home with an attractive introductory rate, only to see their monthly payments soar when the rate adjusts upward. The lack of planning for children's education or retirement leads to missed opportunities, while the allure of get-rich-quick schemes and financial scams preys on those desperate to catch up. The consequences can be devastating: lost savings, foreclosure, or years of financial insecurity. As retirement approaches, the consequences of earlier financial missteps become painfully clear. Those who have not invested early and consistently may find themselves with insufficient savings to maintain their standard of living. Relying solely on Social Security or a pension is a risky bet, especially as lifespans increase and healthcare costs rise. Many underestimate the corrosive effects of inflation, which quietly erodes the purchasing power of savings. Picture a retiree with $50,000 set aside at age 65, expecting it to last 2 decades. But as medical bills mount and everyday expenses climb, that nest egg may be depleted in just a few years, leaving them vulnerable in their most fragile stage of life. Old age brings its own unique set of financial dangers. Cognitive decline can make it harder to manage money, increasing the risk of falling victim to frauds, scams, or unscrupulous advisors. Poor estate planning, or no planning at all, can leave families mired in disputes, facing unexpected tax bills, or watching assets dissipate through mismanagement. The tragedy is compounded when dependents are left unprepared, forced to scramble for resources in the wake of a loved one's passing. The sum of these dangers is not just personal hardship, but societal cost. When large numbers of people lack financial literacy, the effects ripple outward. Higher rates of bankruptcy, increased reliance on social safety nets, and greater vulnerability to economic downturns. The cycle of debt, poor budgeting, lack of savings, bad credit, and investment ignorance perpetuates inequality and stifles opportunity. But the story does not have to end in crisis. Financial literacy is a skill that can be learned and strengthened at any age, and there are practical steps individuals can take to protect themselves at every stage of life. For young people, the key is education, learning the basics of budgeting, understanding how credit works, and appreciating the power of compound interest. Simple habits, like tracking expenses and setting aside a portion of income for savings, can make a world of difference. Parents and schools can play a crucial role by introducing financial concepts early and often. During the career-building years, the focus should shift to building an emergency fund, living below one's means, and beginning to invest for the future. Understanding the fundamentals of retirement accounts, employer benefits, and the importance of diversification can provide a strong foundation. Seeking advice from reputable sources and avoiding the temptation to keep up with the Joneses can help maintain financial discipline. For families in midlife, it's vital to read the fine print on major purchases, compare loan options, and avoid high-risk financial products. Establishing clear goals for children's education and retirement, and reviewing them regularly, ensures that savings stay on track. Vigilance against scams and too-good-to-be-true offers is essential, as is seeking professional advice when needed. As retirement nears, it's important to reassess financial plans, adjust for inflation, and account for healthcare costs. Diversifying investments and considering long-term care insurance can provide added security. Staying informed and engaged with one's finances helps prevent costly mistakes. In old age, protecting oneself from fraud and ensuring that estate plans are up to date can safeguard both assets and family harmony. Communicating wishes clearly, preparing legal documents, and involving trusted advisors or family members can prevent confusion and conflict. The bottom line is clear. Financial illiteracy is not just a personal shortcoming, but a risk that grows more dangerous with time. Its consequences touch every aspect of life, from daily survival to the legacy we leave behind. By taking proactive steps to build financial knowledge and habits at every stage, individuals can break free from the debt trap, achieve greater security, and create opportunities for themselves and their loved ones. Financial literacy is not a luxury, it is a necessity, and the sooner we embrace it, the brighter our futures will be.